Hey everyone, welcome back to the channel. Today, we're going to talk about some recent news around Alibaba that I've seen a few times pop up online. Back in the middle of March, Reuters published a piece titled "Reeling from China's Crackdown, Alibaba and Tencent Readying Big Job Cuts." The first paragraph of the piece is pretty worrisome sounding as an investor in Baba. Alibaba Group and Tencent Holdings are preparing to cut tens of thousands of jobs combined this year in one of their biggest layoff rounds as the internet firms try to cope with China's sweeping regulatory crackdown. Now, the article goes on to say that one source for Alibaba estimates that it can make cuts to more than 15% of its total workforce, which would be about 39,000 jobs. These job cuts would be the first major layoffs since Chinese regulators launched an unprecedented campaign a year and a half ago to rein in internet giants. The article does a really good job summarizing what is happening and the potential cause of these layoffs. It goes to say the regulatory crackdown coupled with a slowing economy has sharply slowed sales growth for most of the internet companies, smashed their share price, and made new capital raising and business expansion much tougher in the world's second largest economy, forcing companies such as Alibaba and Tencent to look for ways to cut operating costs. I don't think there's a way to really sugarcoat this. It sounds as if Baba has overexpanded and underestimated the impact of regulations and the timing of a market slowdown that could potentially have on their operations. The only positive thing I could take from all of this is that it sounds like Baba is being proactive. They've realized maybe growth will be slower than anticipated, and due to this, they're actively taking measures to cut costs and keep the company profitable. Now, my only worry here is if they cut too many jobs and can't retain market share because of it. Something to note here is this still appears to be speculation. Baba hasn't released a formal announcement, at least that I can find. However, I still wanted to update my DCF and build out a kind of worst case scenario and see what we get. First, let's jump back into the latest DCF I've pulled together and review those assumptions we made. So for 2022, we layered in 19% revenue growth, and that's compared to 41% in 2021. So already layering in a slow growth when we held it relatively flat through 2024 before having it drop towards lower double digits of 11% annually. Our estimate for 2022 was based on the reported 9 months growth, which was at 22.5%, and then reduced slightly to be conservative. And quickly looking at product development, sales and marketing, and general and administrative, we can see we held these flat to 2021 levels as a percentage of revenue over the next decade. Now, hopping into the updated worst case DCF, based off the recent news that Baba is actively taking steps to reduce operating expenses, this would lead me to believe revenue may actually be lower than our already reduced assumptions after 2022 going forward. But at the same time, we would expect to see larger reductions in their operating expenses as well. So for this, we've modeled in 2023 revenue to be the same as 2022, which is actually 2% lower than our previous model. And then we'll have revenue growth declining 2% annually until 2027 and then holding flat at 11%. This gets our updated revenue in 2031 to 2.5 trillion RMB, which is almost 200 billion RMB lower than our previous model. The next set of assumptions to be updated will be our operating expenses. For this, we take a relatively simple approach, and we're reducing product development, sales and marketing, and general and administrative all by 10%. We will assume a 15% headcount cut across the company will yield savings, but less than the amount cut, as there will be some fixed costs in all of these operating buckets. And then the last assumption we'll need to adjust is going to be capital expenditures. What I've done here is I have it growing in terms of absolute dollars, but decreasing as a percentage of revenue. The reason for this is if we're no longer expecting a 30 to 50% annual revenue growth, the amount of capital investment will decrease as a percentage of revenue, but still should remain increasing in absolute dollars as we still have Alibaba growing. So based off these assumptions, our updated valuation at a 20% discount rate is $303 to $305 billion USD. Compare that to the market cap of around 320 billion, we could say Baba is most likely a hold. Now, something I want to note here is we are using a 20% discount rate. This rate took into account in our latest model the risk of the Chinese government regulations, the VIE structure. And with that said, I'd argue by baking in even lower revenue expectations, we've actually built in kind of more regulation risk than we originally anticipated. So almost entirely from these regulations put into place a year and a half ago, This is where the question comes into play on your outlook with China. If you think there aren't more regulatory actions to come, you could drop this discount rate and you could get a very different conclusion. Let's quickly look at the valuation of Baba if we have a range from 10 to 20% for the discount rate. What we can see is even if you drop the discount rate 1% down to 19, Baba is actually fairly valued now. And if you drop this rate 5% down to 15%, you get a valuation between 439 to 447 billion. Now, the hardest part of any valuation is quantifying the appropriate amount of risk via the discount rate. If you're going to do a standard blue chip in the US, use a 10% discount rate and you can feel pretty comfortable. If you're looking at a growth company, 10 to 13% is probably pretty safe range if the company has consistent, strong top-line growth. Now with China, it's tough. It could go to zero tomorrow if China decides the VIE structure is no more. Alibaba is a tech giant with over 100 billion USD of revenue annually that's been growing upwards of 40%. If Alibaba was in the US and you slapped a 10% discount rate on this, you'd get a valuation between 780 to 820 billion USD. However, they are in China, and buying shares that are listed via a strange structure that many people don't fully understand does have real risk. I think if we were in a better political time, ongoing wars were stopped, you could slap a 15% and call it good. But with the current events in the world, I'd take the middle ground between probably a 20 and a 15%, say 17 or 18. And you're going to get a valuation between 340 to 380 billion. This lines up pretty closely to where they're trading at currently. So I would still give it a hold even at a lower rate. Now, if the stock drops back down to 75 a share and the market cap is back below 250 billion, it is a clear buy like it was a few weeks ago. What I'll be looking for now is to give it a solid buy rating in 2022 is any results or management guidance that can, provide guidance around the layoffs or future outlook for revenue growth. If growth will be a bit better and world tensions ease up, quickly goes back into the buy category from a hold. I do want to note, Baba is my third largest stock position, not including ETFs, and it sits behind Google and Apple. I'm trying to actually give my opinion on stocks and not hype things up just to tell people what they want to hear. I don't think anything has fundamentally changed with Baba, but the news of mass layoffs makes me believe future growth could actually be significantly slower than I had anticipated, but only time will tell. I'll be watching closely to see how 2022 pans out and if we are seeing any of the trends in anticipated operating costs, CapEx, and revenue growth. But anyways, as always, thanks so much for watching. Leave any questions or comments below and I'll get back to you. And if you haven't already, please like and subscribe.